Hi, I'm Jimmy. In this video, we're looking at the Dividend Aristocrats ETF to try to see if dividend stocks are overvalued or undervalued relative to the market. We're going to break them out by sector and then once again by individual company, do a quick run through it to see if we can find any dividend stocks that look like they could be a decent value buy today. Okay, so let's start with the big picture. So right now, the S&P 500 has an average PE multiple of about 21 times earnings. While the Dividend Aristocrats ETF, well, they have an average PE multiple of about 20 times earnings. So at first glance, it looks like dividend stocks are not too overvalued compared to the market. We'll call it they're about fairly valued. Now, when we go sector by sector, here's what that looks like. And ultimately, what I did here is I broke out the S&P 500 by sector and NOBL by sector, and then compare them so we can get an idea how the sectors compare to each other. To me, the most interesting sectors are communication services, which has a PE multiple of about 16x versus the S&P 500 for the same group of about 22x. Consumer discretionary looks interesting as well, with NOBL coming in just short of 21x and the S&P 500 coming in slightly above 24x. So there could be some value there. Then finally, healthcare looks interesting. Their NOBL comes in about 19x, and the S&P 500 comes in at about 21.5 times profits. So that could be another interesting spot to look. Now, some of these numbers for NOBL are skewed a bit, and the perfect example of that is the communication services sector that we mentioned first. When we go to the next level with all of the companies from NOBL, well, we can see that AT&T is the only company in NOBL from the communication services sector. So for me, that's a real bad representation of what dividend stocks from that sector are doing. It could say something about the interest in AT&T. That could be something we want to dive into later. Now, I've actually done some videos on AT&T, so if you're interested, there'll be a link in the description below. But for now, let's just focus on the other two sectors, which is consumer discretionary and healthcare. So when we limit to those companies that are in NOBL from those two sectors, well, the first thing I did is I added the current PE multiple for each company, and then I went ahead and got the 5-year average PE multiple. That way we have something to compare our company to compared to its own history. And based on just this information so far, well, Genuine Parts looks interesting since it's currently trading at less than its 5-year average, and Lowe's looks like it could be a decent value when we compare that to its own 5-year history. And when we skip down to the healthcare sector, well, here it looks like AbbVie and second, Cardinal Health both look like they could be undervalued relative to their own history. But this brings us to another important point I wanted to bring out, and that's how price to earnings is actually calculated, or really how earnings per share is actually calculated. And AbbVie is the perfect example for this. So right now, I have AbbVie listed as a current PE of about 12x. But if we head over to Yahoo Finance, well, we can see that Yahoo Finance has their current PE, their trailing 12-month PE, at about 40x. So why the huge disconnect, we might ask? Well, the primary reason is that I personally like to use adjusted earnings per share versus the US GAAP earnings per share that Yahoo Finance uses. So just to illustrate, as an example, back in 2018, well, Yahoo Finance shows adjusted earnings per share of $3.66, and the number I'm using is actually $7.22. Now, AbbVie made this simple for us because in their earnings press release, they give us this table. Now, this is the adjustments made from the $3.66 all the way down to the $7.91. Now, the concept here is that we, as potential investors, should adjust GAAP earnings. GAAP is generally accepted accounting principles. We adjust those earnings based on maybe one-time expenses or one-time revenues that aren't really core to the company's business. So as an example, we take these impairment charges here. Well, these are things that the company believes should be added back to get a better understanding of what the core earnings actually were. And then if we were to look at these negative numbers here, well, these negative numbers they happen in the opposite directions. There are deductions that are happening. So in theory, there were tax benefits. Those tax benefits likely won't happen next year. So you deduct those from this year's current profits. Now, if we wanted, we could just take the $7.91 as is and use that. But personally, I like to remove intangible asset amortization since that one's a bit trickier and it's much more reoccurring than some of these other ones. So I like to remove that one And if we remove the 69 cents impact from that number, well, we end up with the EPS that I'm using of $7.22. So that's how we get a PE ratio of 12x, because we take the 87 or so dollars that AbbVie is currently trading at, we divide that by $7.22, and we get about 12x. Now, I know that this can be a pain to look at and a pain to go through the process of it, and I've actually thought about doing a video on the popular adjustments that should probably occur from most earnings reports. Many companies map it up just like AbbVie did, so that's something to watch for. But if that'd be something you're interested in, that type of video, please let me know in the comments below. Okay, now going back to our list here. Now, I didn't just want to use the PE ratio and stop there. I was also trying to use the dividend discount model that I discussed in a recent video where we talk about trying not to overpay for dividend stocks. Now, what I did is I took a generic required rate of return of 8% for this entire list. Well, when I applied that formula to all of the companies on the list, this is what it looked like. And I hate to say this, but I actually found the results of this to be mostly unusable. To get this formula to really work, we need to break down each company. We have to come up with a much more accurate dividend growth rate. We need a more customized required rate of return for each company based on the level of risk. So I found that it didn't really work when applying it to a whole list of dividend stocks. So I actually think that our best move is to take what we learned from the PE ratio analysis, which is basically for us to go fishing in the consumer discretionary and the healthcare sectors, and possibly look at AT&T as well, and see if we can find at least a few undervalued dividend stocks that seem like they could be good right now relative to their own history, relative to the sector, and relative to the overall market. Now, it could make sense for us to analyze each of the companies in NOBL to get much more in the trenches and figure out what each company is potentially worth. Instead of trying to do it in a list format like this, really dive in and see what we think, sort of like we did with the Dow 30 series that we did on this channel. If you're curious about that series, well, in that series, we analyzed all 30 companies in the Dow Jones Industrial Average with the goal of creating 3 different portfolios: a value portfolio, a dividend portfolio, and a growth portfolio. This is a dividend portfolio that came out of that analysis. So if you'd be curious to see us break down all the companies in NOBL as more of a specialized dividend company analysis series, please let me know in the comments below. We could do something just like we did for the Dow 30. And if you're curious, that could be a good next video to watch. Watch the dividend portfolio, and then you can go back and look at the analysis that we had done for each company to sort of see how we got there. If you'd be interested in seeing something like that, please let me know in the comments below. If you haven't done so yet, please hit the thumbs up, hit the subscribe button. Thank you so much for sticking with me all the way into the video. I really do appreciate it. Thank you, and I'll see you in the next video.